So it's just a few minutes after 6:30 here, and I wanted to thank everyone for, again, taking the time out of their busy day to join me. Today, we're going to talk about a few things. The agenda that we have for the day should come up here any minute, is to talk about the advantages of incorporation. And specifically, I'm going to give you a little bit of background about our organization, who we are, as well as the different forms of organization that are available to us. And then we'll go into some of the advantages of incorporation, as well as discuss how we maximize the benefits of the incorporation, and then talk about one of the big issues, which is personal service businesses and what we can do to protect ourselves against that risk. I always start off by telling everyone that good advice is priceless. Whether you use me or someone else, I do encourage you to use a professional and to get one that educates you and that actually asks you questions. And most importantly, that you actually understand. Sometimes it's really easy for accountants such as myself to get lost in the numbers and forget that our clients don't always understand income statements and balance sheets. And it's our job to convey what can be complicated information to you in a simple format. So whoever you're going to use, probably the best way to find someone is to ask for a referral. And of course, I think one of the FAQs did talk about whether you actually need to hire an accountant to prepare your corporate tax returns. The answer is no, you do not. You can prepare your own corporate tax return. But again, the answer I had before is OJ also could have defended himself, but probably not a good strategy. So to give you a little bit of background on who we are, we're a firm of chartered accountants. We specialize in service-based professionals. We started by focusing on IT consultants, which is where we got the name Chartered Accountants for Information Technologists. We have been specializing in independent contractors since 1984, and we've serviced tens of thousands of clients over the years. We're also an ISO 9001 registered firm, which basically means that we have systems, processes, and procedures, and a feedback loop for constant, never-ending improvement. We also have offices across Canada, though in today's day of technology, that's becoming less and less important as we're able to service people in any location using products such as GoToMeeting and other cloud-based applications for hosting and serving financial information in a secure and professional way. So what do? We provide proactive strategic planning, financial quarterbacking, business coaching and management, financial planning, all the usual stuff that you would expect an accountant to do, and hopefully a little bit more. Why do we do it? We do it because we enjoy working with a very select group of creative and fun people, and we enjoy being part of something exciting. And it gives us the opportunity to be creative and to do stuff that is different than what other accounting firms are doing. And of course, it never hurts to be able to minimize the pain of taxes and to help entrepreneurs succeed. And there is truly nothing more rewarding than a job well done and having satisfied clients who really truly appreciate you. So that's why we get out of bed in the morning each day, is to help entrepreneurs succeed. So why do contractors choose us? For a lot of reasons. The four most common are our free initial consultation. So we'll go through the pros and cons of everyone's individual situation and make sure that we actually can benefit you and that there is a fit, because we're not interested in establishing a relationship that's not a good long-term fit. We want clients that are a match for our niche and that we can truly add value to. The other advantage is that we are turnkey and we can provide an in-house solution, including paralegal services, as well as the typical accounting services. Now, I know that you guys are lawyers and that you may be able to do incorporations yourself. And again, this comes back to making sure you get things structured correctly from day one. If you're familiar with preparing articles of incorporation, you know the share structure that you want to do that's going to position yourself in the most effective way in the long term, then feel free. If you're not sure, I encourage you to use a professional. And one of the advantages you have of using our firm, particularly if you're coming through Procom, is that you can get the paralegal work done for the same cost as if you were to do it yourself online. So we'll do all the minutes and share certificate, and we'll talk a little bit more about all what's included in our package for the same price as if you just went out and bought your minute book and seal and filed your articles and your name search and all the typical government fees that you'll have to do. We also provide benchmarking, where we compare each client's financial information against an average and a median, which helps us to pinpoint areas of opportunity as well as areas of risk, to make sure that the clients are maximizing their benefits of their corporation and minimizing their risk. And then in regards to minimizing risk, we also offer something very unique, which is audit protection services. And well, I guess it used to be, we used to be the only firm offering audit representation protection. But I do believe H&R Block is now sort of copying us. And as I've said before, imitation is the sincerest form of flattery. So I guess it's a compliment on what we've been doing, because we have been offering audit, and we're back. So I'm not sure what that was about, but I'm hoping everyone's back. If you do not hear my audio, please let me know. Can everyone hear me okay? I'm not seeing any hands go up. So I assume everything is okay. I apologize for that. I'm not sure what it was. Okay. So now we're on to the three primary forms of organization. The three forms of organization that are available are sole proprietorship, partnership, and incorporated entity. I'm going to go through each of those one at a time. So the sole proprietorship, the advantage is that you're eligible to deduct expenses. You can do income splitting with a spouse, and it's very inexpensive to set up and register. In fact, if you're not registering an operating name, all you have to do is register a HST number, and that's if and only if you're exceeding $30,000 in revenue. So it can be actually no cost at all to setting up. The downside is there is an unlimited level of liability, and you must pay employment insurance. In addition, the income is subject to the personal tax rate, and what that means is that any income that is over and above your deductible business expenses will be taxed at whatever your marginal tax rate is. And of course, because it's basically a complicated personal tax return, you must have a December 31st year end. So the other option is partnerships. They're also fairly inexpensive to set up, but you must register a business name with the partner. You're still eligible to deduct expenses, and there is income splitting available, and there's also no EI premiums. However, these also have unlimited liability, and the big issue here is that either partner can legally buy the other, and that's probably the most important issue. So for that reason alone, we're not a big fan of partnerships, and we do encourage people, if you're looking at a partnership, to look at setting up a corporation and partner through the way of share structure. And again, we're have the same issues with income being taxed if it's even if it's not taken out of the corporation, and the fact that we must have a December 31st year end. So incorporation, we have the most advantages here. So we've got limited liability, no EI, the ability to do income splitting, long-term savings plans, and broadens your ability to get contracts. And what we mean by that is that there are actually many agencies that actually will not work with sole proprietors. So by being incorporated, you do expand the opportunities that are available to you. But the greatest advantage of a corporation is the ability to leave money inside the corporation and pay the low tax rate, which in Ontario is only 15.5% for an eligible small business. Now, the only downside here is that there's some cost to set up and maintenance. So basically, we want to look at a situation and say, are we getting enough financial benefit to overcome the cost of setup and maintenance? And if we are, then we should go ahead and incorporate. If we're not, there may still be some benefits, some non-financial reasons to incorporate, but usually we look first to the financial advantages. And the bottom line is, if you're saving more in taxes than it costs you to set up and maintain, it should be a no-brainer. So talking about some of the financial advantages of incorporation, again, we mentioned a small business deduction. We also have the ability to do income splitting, which we'll talk some more about later today. And we have the ability to do tax-free loans, dividends, and the ability to smooth income. One of the things that I like to talk a bit about are the ability to smooth income and this increased rent and automobile expense. What we mean by the ability to smooth income is that with the marginal tax system that we have here in Canada, the more income you have, the higher your tax rate will be. So the goal is to smooth out income and eliminate peaks and valleys, because with the marginal tax system, if you have 1 year of $100,000 and a 1 year of no income, you will actually pay more taxes than if you had 2 years of $50,000 in income. So if we can take income, or even if it was, 120 and 80, and we just smooth that to 100 each year, you're going to be better off, because the higher your income goes, the higher your tax rate. So if we can smooth income over 1, 2, and sometimes even 3 years, we can substantially improve the amount of taxes, or reduce the amount of taxes we'll pay. In addition, I also mentioned briefly that there's increased rent and automobile expenses. And as I mentioned when I was down at your offices, this is a big misconception for a lot of people. There's many sole proprietors that are out there deducting their home office when they're not truly entitled to do it. And just because you've deducted it on your tax return does not mean that you have indeed gotten that deduction. Until 7 years have passed, and after your notice of assessment is the only time that you are truly secure that you have, in effect, gotten away with a deduction that you may or may not have been eligible for. Until that time, you are at risk of reassessments and interest and potentially even penalties. And with the home office, in order for it to be deductible as a sole proprietor, it has to be a primary place of business, or you have to be meeting with clients there directly. And while there is some leeway and flexibility on this, as meeting clients is becoming a looser term with technologies such as GoToMeeting, it is still a lot more difficult to claim than if you were incorporated, where an incorporated entity just have to have an office space available for them. It does not need to be their primary place of business. So the home office expense in and of itself can be a $3,000 to $5,000 deduction, which, even if it's just saving you at the small business section 15.5%, can start to be a significant advantage and start to cover some of the costs of setting up a corporation. And then that gets magnified because another little known fact is that in order to deduct your mileage from to be specific, mileage from your home to your office is specifically disallowed. However, mileage from your home office to your work site is allowed. So if you don't have a home office, you can't claim the mileage from your home office to your client site. So losing the home office can also mean losing the automobile expense, which can be another 3 to 5, and sometimes, depending on how much you're driving, up to, I've seen clients over $10,000 in deductible automobile expenses. So you look at those two factors alone, and they're going to probably cover the benefits of incorporation. Now, that being said, if you don't have an automobile and you don't have a car, obviously it's going to limit the benefits. So then we talk about some of the non-financial benefits, which is the ability to protect personal assets and the ability to increase your marketability. So I touched on increasing your marketability earlier by mentioning that most or many placement agencies will not deal with sole proprietors. So by being incorporated, it does open up the market that's available to you as far as opportunities available. In addition, you have the ability to protect personal assets. So there is limited liability with a corporation, and there are ways to set up corporations and holding companies, and ways to protect personal assets against risks that may or may not exist. So there's a lot more opportunities that are available with a corporation than they are when you're working independently. So getting to the nuts and bolts of it, and of what most people are concerned about, which is the bottom line of how much money am I going to save by being incorporated, and is there going to be a financial benefit for me personally? So what I've done here is taken a financial comparison of a sole proprietor and a corporation, and really simplified this to its lowest terms. I've taken out CPP and I've taken out EI from the calculation, and I've given both contractors the same amount of expenses, which, as we mentioned earlier, may not in fact be the case. But for simplicity's sake, just to show you the financial advantages in two people who are in the exact same situation, which probably is unrealistic. But one with the ability to leave money inside the corporation at a corporate tax rate of 37 or a corporate tax rate of 15.5% will actually save um, over $6,000 by being incorporated. So obviously that would more than compensate for any additional costs of incorporation and maintenance of that corporation, including the filing of the corporate tax returns. So in this situation, both individuals have $40,000 of deductible expenses. Both have a spouse earning $30,000, which is a fairly safe income spending number, and the one contractor has taken out and spent 43, which means effectively the person who is incorporated has had access to $113,000 of disposable income when enabled to leave $37,000 in savings, leaving them about 37, actually, I guess it would be about just under 32 in retained earnings in the corporation in their first year of operation. This may not be feasible for everyone, but obviously the more money that you can leave in the corporation, the greater the financial advantage. And if you are in a two-income family and you have a spouse that's a full-time employee, sometimes the ability to leave money inside the corporation can be even greater than this, because you may be able to use the spouse who's the full-time income and live primarily off of their source of income and use your income inside the corporation as your savings vehicle. And obviously this gives you the greatest flexibility and advantages. So talk now a little bit about how we're actually going to maximize the benefits of the corporation. So obviously the more proactive you can be, the better off. And what we talked about above is the ability to leave money inside your corporation. And one of the things that we are constrained by as accountants is your spending habits. And if you are pulling every single penny out of your corporation, we cannot or we can't leave money inside the corporation to have a taxable corporate tax rate. Now, there are some exceptions to that, which we'll talk a little bit later, including taking home and auto loans. So there's ways to draw money out of the corporation without it becoming income. But usually, if you take money out of your corporation, you're going to be taxed on it personally. So the best thing you can do is do some tax planning and work with your accountant to be proactive. And if you have a strategy and a plan, you'll end up in a much better financial position than if you're just being reactive. So one of the things we see a lot is people leaving a lot of money on the table. It's not uncommon for me to go through an initial consultation or a first year review with someone and find thousands of dollars of money that's been left on the table for one of three reasons. They either don't know what they can deduct, or they've done a poor job of record keeping, or they're just afraid of Revenue Canada. And these are three things that should be easily solved and can be eliminated. And in fact, we've got a number of tools that we use to help eliminate these. But when it comes to lack of knowledge, that's the job of the accountant, to make sure that you're educated and informed. And hopefully a good accountant is also going to provide you some record keeping tools to help mitigate that. And then, of course, fear of Revenue Canada. Some people certainly have a lot more fear of dealing with CRA, but from my experience, that they're not a big evil machine. Most of the auditors are very reasonable people that, if dealt with professionally, will treat you professionally. So I'm going to actually skip this slide for a second and come back to it for a minute, because I wanted to talk about some of the tools that we use for maximizing the expenses, and specifically to help combat some of the issues we pointed out earlier. So we have our own proprietary online bookkeeping tool, but we also have new great cloud-based technologies out there that can really simplify the bookkeeping process. Being from Toronto, I'm a big fan of two products, which would be Wave Apps and FreshBooks. Now, FreshBooks is not a double entry accounting system, but it can get you the majority of the way there. And most service-based professionals don't really need to manage the balance sheet, which is usually for accounts receivable, accounts payable, inventory, non-current items. So those people who are comfortable just tracking their revenue and expenses can use something like FreshBooks. If you do need or are concerned about tracking any balance sheet items, then a good web-based debit and credit system is Wave Accounting. Now, both these tools are free. If you are looking for sort of a higher end paid application, my number one recommendation would be Xero with an X. I'm not a big fan of QuickBooks just simply because I've seen so many issues with the tool. Now, as I mentioned earlier, we also provide a benchmarking tool to help resolve those issues with people not being aware of all the deductions that they could be aware of, or that they should be aware of. So when it comes to lack of knowledge, our benchmarking tool is really going to help us to pinpoint areas where you're below the average and allow me as your account manager to ask you some very simple questions to pinpoint items that you may or may not be aware that you can deduct. And then, of course, we talk about audit representation protection, which is used to sort of help mitigate the risk of dealing with CRA. And the way that works is we'll represent you up until the third and final stages of appeals at no additional cost. So it's a great value add, and more important is it's a total comfort package, which is really essential when independent contracting is something that's new to you and you're not aware of what all the risks are and what your liability is. So for most of our clients, this audit representation protection is completely free. And as long as you prepay for your services, there's, like I say, no additional cost for this whatsoever. Now, just stepping backwards for a second, talking about maximizing expenses, it's important to know what we can and can't deduct. And what a lot of people don't realize, and what a lot of people expect, and IT people and lawyers are probably looking for things to be exact, but the reality is they're not, and they're really open to interpretation. And there are a few things that are specifically disallowed by the Income Tax Act, but most items aren't. And if it's not specifically disallowed by the Income Tax Act, really the only criteria is that it has to be spent with the intent of helping your business to earn income sometime in the future. And as I mentioned here, that is very vague, and it leaves a lot of room for interpretation. And the reality is the person who knows best the answer to that question is you, the business owner. So what we try to do is encourage our clients to maximize their interpretations of what is and is not deductible. Now, of course, as a firm of professional chartered accountants, we will not allow anyone to do anything fraudulent, but we do encourage you to maximize every deduction that we believe you're entitled to. And if it's not specifically disallowed, it's fair game as far as we're concerned. And when we talk with clients, oh, I see a hand. I don't know how long that's been up for. Give me 1 second. When we talk to clients, okay, the hand went away. Someone did have a question. Feel free to pop it up again. I'm sorry if I missed it. But when we talk with our clients, we offer what we call full option accounting, which means I'm going to lay out the options from aggressive to conservative and allow our clients to make a decision on where on that spectrum they fall. And we basically categorize deductions into 3 categories, which is basically defensible and winnable, defensible and we're not sure whether it's winnable or losable, and not defensible. If it's not defensible, then obviously we can't take the deduction. If it's defensible, we're happy to claim it, whether or not we believe it is winnable. And of course, if it's defensible, winnable, to us it's a case that we've had success with in the past and we have no issues with whatsoever. Now, I'm going to move into some specific categories and talk about the different things that you can deduct. And if you have any questions about any of these, please feel free to chime in at any time. So one of the important things I like to talk about is the difference between advertising and business promotion. And it came up with a very direct question at our in-person session. And I brought some pizzas for the group, and the question was, is that going to be business promotion or advertising? And that's going to be advertising, because when we have a large group event, we can categorize this as an advertising event. And the reason this is important is because advertising is 100% deductible, whereas most other meals and entertainment are only 50% deductible. Now, you are required to be able to recall who you had meetings with if you are going out for meals and entertainment. So, while we encourage everyone to record the name of the person that they had that meal or entertainment with, the reality is most people don't. And as long as you've kept a calendar and you can go back and recall who that meeting was with, that should be sufficient. We also believe that as business owners, that you are constantly networking and developing relationships. And therefore, virtually any meal or entertainment or drinks or social event that you're going to and spending money on is, as far as we're concerned, a legitimately deductible expense, even if you're not specifically discussing work. Because as everyone knows, networking and relationships building is not about going out and directly asking for a referral. I mean, if I took a client out for lunch and asked him if he would buy a very expensive computer from me, he'd probably say no. But if I took a client out for lunch and told him I was, had a new product and we were selling these great computers, well, he may not particularly be directly interested in himself. He may recommend that product on to someone else or refer me to people he knows who are currently looking for computer support. So it's that sort of indirect relationship building, which when it comes to consulting is not even as defined as a product, but is still very legitimate. And in fact, you can even take meals and entertainment for entertaining that you're doing in the home or for entertaining that you're doing with a colleague or a friend, but you're not paying for that colleague or friend's meal. So two of you guys go out for beer and pizza after this event, and you want to claim it even though you didn't pay for the other guy's beer and pizza or other girls' beer and pizza, that's absolutely still legitimate. So as I mentioned, you should keep a diary and note who you've had to deal with. But the reality is, again, not really done all that often. The other thing about advertising expenses is that you can actually give other employees up to 2 non-cash gifts per year, and for any special occasion, birthday, Christmas, anything that you can think of. So this is another great tool for getting money out of your corporation without having to pay any tax on it, because every dollar that you have in a deductible expense is a dollar that you don't pay taxes on. Now, the other thing about advertising expenses, historically, clients have deducted business clothing in their advertising, and including dry cleaning. Now, this is an area that's gone through some increased scrutiny. So I do caution people to be a little bit careful if they're claiming their business clothing, because the original case, which was a case called the Huffman case, was an undercover police officer who was able to demonstrate to the courts that the clothing he used for his undercover duties were specifically used for his undercover duties and therefore legitimately deductible. But subsequent to that case, there was another case which was a female consultant who took everything, including her underwear, literally. And unfortunately, what happened was she lost the entire deduction. And what we sort of saw that as is a case of, pigs get fat, but hogs get slaughtered. So we sort of dismissed it until the more recent case, or the most recent case, which was actually a lawyer who was only claiming his suits. And we were pretty shocked to hear that the judge deemed the suits to be personal and considered him to be getting enough personal use out of those business suits for them not to be deductible. Now, me personally, I wear business suits and dry cleaning specifically to the office, and I do consider it my uniform. And I still continue to claim that deduction and will argue until I'm blue in the face that it's a legitimate deduction. However, I am aware of the risk I am taking by doing that and recognize that I'm into one of these situations where we have a defensible but possibly not winnable case. So I've got an argument, but that argument is becoming harder and harder to win. So motor vehicle expense, it's important to note about automobile expenses that there's 2 methods for calculating the automobile expense, the actual or the mileage. And most situations, the mileage is the best method. However, there are circumstances where the actual can reap a greater reward. And what we encourage everyone to do is to keep track of both methods and to use whichever method is results in the greatest deduction. And you are allowed to switch back and forth from one year to the next. What you are not allowed to do is if you have two vehicles to claim mileage for one and actual for the other. Another interesting question is when people ask me whether I should buy or lease, um, which I do get quite frequently, is if you're using the mileage method, obviously there's no difference between leasing or buying. If if you use the actual, then what happens with the purchase is that you will take an amortization, which in the first year is 15% of up to a maximum of $30,000 plus HST, and in each subsequent year you take about 30% of the remaining value. And with the mileage or with the leasing, you will actually just take the lease amount up to I think it's a maximum of $800. Now, the funny thing about this is that um, the lease and over the if you were to use the lease method and use actual expenses for the entire course of your career, you would get a greater deduction using the lease because you're actually going to be out of pocket more money. However, if you take the mileage method, or if you purchase the vehicle and you in the first couple of years use the actual method because you have a large depreciation, and in subsequent years when your depreciation diminishes and you still have a high amount of mileage rate, you can actually end up with the best of both worlds in that situation where you use the actual in the years where it's the peak amount and then move down to the mileage once that depreciation has disintegrated or become small enough that you're not getting as much of an advantage. But the reality is, when it comes to lease or buy, the greatest advantages really come, or the greatest differences come in what the dealership is going to offer you as far as lease buyouts, mileage rates, borrowing costs, because those will probably have a greater impact on your true financial situation than whether you're actually deducting a lease or a purchase. So home office expenses, we take a percentage of insurance, utilities, property taxes, maintenance fees, and either rent or mortgage interest. We're not taking your mortgage principal, just the mortgage interest. Now, one of the things that we do, again, that's a little bit unique, is we have a proprietary method for calculating the home office that we've successfully defended. And what we do is we take your office plus your garage, because that's used to store the vehicle or storage of office materials, files, and those types of things, as the numerator. And then for the denominator, we'll take the total home office square footage plus the garage, because we use that in the numerator. We'll subtract the common areas, which are the kitchens, the hallways, and the bathrooms. And by doing that, we can take a typical deduction, which might be 10 or 15%, and jump that up to 20 to 25%. And obviously, when you're talking, average person having maybe mortgage interest of, $10,000 to $15,000 a year, an extra 10% of that can be substantial. So obviously, some great advantages to the home office and some very unique strategies that we use to maximize that. Books and periodicals, more and more we do find people are reading online. But what we do tell people is anything that you read at all, whether that's fiction, newspapers, magazines, it's all deductible because it's all part of your knowledge base. And even if that is fiction or it's magazines, it's all still legitimately deductible. And of course, online ebooks, audiobooks, all those are deductible as well. So education and seminars. This is a good one because we got a very direct question on this last time too about if you have law school expenses, can you deduct those to the corporation? The answer is yes, you can, but you probably don't want to. Because if you're going to get an education tax credit, you probably want to file that on your personal tax return, as it will give you a greater benefit. What you want to reserve for corporation is the education and seminars that is not eligible for a tax credit. So things like certifications, additional courses that you might want to take areas of interest that are not going to be taught by a registered institution and that won't be eligible for tax credit. Telephone and internet, you can take your cell phone, your internet, long distance, secondary lines, but the interesting thing here is you can't deduct your home telephone line. So your primary home telephone line must be excluded from this deduction because it's one of the very few items that is specifically disallowed. Just a notification there. We also want to talk a little bit about insurance. From a deductibility standpoint, there's essentially three types of insurance. We have health, dental, errors and omissions, which are all legitimately deductible with no issues whatsoever. Then we also have disability and life. Disability, you're allowed to deduct it, but if you choose to deduct it, the benefits become taxable. And unfortunately, if you do need to make a claim on disability, you probably need access to as much of that money as possible. So we do encourage people that if you are going to be getting disability, which is fairly expensive, that you opt not to deduct it, and that way you can get a lower payout, which will also equal a lower premium. Now, life insurance is different still from the other two in that it's specifically disallowed, but there's again a little loophole here. If you set up the beneficiary of a life insurance plan as the corporation, the money can go into a capital dividend account and come out to the beneficiaries tax-free, and it's still not deductible, but it can be included in the income statement and then added back on the tax return, which means that, while not deductible, you don't have to pay tax on the money you're taking out of the corporation to pay for those premiums. So it gives you an advantage. It saves you, the 15.5% or whatever your marginal tax rate is, and on whatever your premiums will be. So there can be an advantage of doing that. But of course, in order to do that, you do have to set up your corporation as the beneficiary, which if you already have a plan can sometimes be complicated. And if it's a term life plan, the benefits are probably going to be small. If you're talking, 15% on, $100 a month, it's not going to be a massive savings for you. So CCA, capital cost allowance or depreciation, we can take a depreciation on fixed assets. Obviously, you're probably not going to have a backhoe, but what you will have are things like computers, office furniture, and small other assets that are depreciated. We used as a threshold $200. Anything below $200 can be expensed. That is not a hard and fast rule. It's a general guideline that we've used over the years that we've been comfortable with. If you've got a situation and it's a little bit over 200 and you want to expense it, and it's a laptop that what I would consider most of the laptops these days to be disposable, I'm probably not going to have a problem with you choosing to claim that as an expense rather than an asset. And obviously the advantage of claiming it as an expense is you get the entire deduction in 1 year. The asset, you will get the total deduction, it's just going to be over a longer period of time. The big thing about assets, though, is that you should talk with your accountant before making any purchases. Like I said, $200 or $300 laptop, you probably don't need to talk to me about. But if you're purchasing a car, a home, anything like that, you want to speak with a professional to make sure that it's being structured as effectively as possible, because there are strategies and tools for different things that we can use to get money out of your corporation in tax effective ways. But if you spend the money first, sometimes we can't use those strategies. And we're going to talk about some of those strategies in just a minute. But before we do, I do want to talk to you a little about the ability to split income taxes. And both sole proprietorships and corporations have the ability to do income splitting. And income splitting is legal. It's a legitimate way to reduce your taxes, and you can incorporate to do that. Of course, evasion of tax law is breaking the law. We're not encouraging anyone to do any falsifying of their information or not declaring any income, and that's the real thing that we want to avoid. But income splitting, absolutely a legitimate option. And what we can see here by this specific example is that if we take one person who earns $100,000, they'd have a tax payable of about $32,000 in change. Whereas if we took two people, they would have taxes payable of about $13,767 for a total payable of $27,000, or a savings of $5,391. Now, in addition to that, this particular calculation takes into account CPP. And what that means is by splitting it into two people, not only do you save $5,000, but you also have double the CPP benefit going into retirement. So you've saved money and actually got a greater benefit. So you basically got another $4,000 and change in CPP benefit by splitting the income. But now let's talk about some of those strategies for these big assets like houses and cars, and some of the strategies that are available for accessing money in your corporation without you having to pay huge amounts of tax. So there are the ability to take loans for single purpose, house, car, boats, RVs. Now, single purpose loan is also sometimes referred to as a debit balance. And what this is any particular reason, there doesn't have to be any reason at all, but in any given year, you can have it so that you pull money out of the corporation and you don't take that money into income. Now, what the rules tell us is that in the subsequent year, that money has to be repaid either in the form of taking it as salary or by putting it back into the corporation. And in that subsequent year, you are not allowed to do another single purpose loan. So basically, you can only do a single purpose loan every other year. Now, on the other hand, you can set up a car loan or a home loan or a boat loan any year you want, and there's no rules that you can't have one in any subsequent years. But you can only do it in the years that you purchase a house or a car or a boat. And there are basically prescribed rates of interest that you must pay back the money to your corporation at. And now what typically happens, because most people don't actually put the money back into the corporation, what happens is the repayment amount, the principal repayment, actually just goes into income of the individual and gets added onto their T4. And then the interest is calculated and added as a taxable benefit to that employee. So while the interest is paid to oneself, there is a real cost to this, which is the tax on the interest. And because you're talking a tax rate on a small percentage, which is about 3%, you're talking a very nominal cost to do this and giving you access to the time value of the money. And loans for homes can be up to 25 years, and for cars could be up to 7 years. So this gives you a way to pull money out of your corporation and smooth that income over longer periods of time, thereby keeping your income artificially low and your taxes as low as possible. Other strategies are the ability to use dividends or accessing money through the use of dividends. And we've got a number here that actually I think is out of date, 28,820. And when we say a tax-free dividend, this can be a bit of a misnomer because it's not actually tax-free. What it is that the corporation has paid the tax on this. And there is something called the theory of integration. And what the theory of integration is intended to do is make it such that if you were to take income as a salary or as a dividend, the taxes would be the same. Now, what happens with a dividend is you will pay corporate taxes up to 15.5%. And if your personal tax rate is higher than 15.5%, you will have to pay that difference on your personal tax return. Now, that's it in its simplest terms. It is a lot more complicated than that because we have what we call dividend gross ups and then dividend tax credits, which is how we get to that principle. But the whole idea and principle is that the taxes should be the same. Now, outside of taxes, there are two other differences with dividends versus a salary. And that is that a dividend is not eligible for RRSPs and it's not eligible for CPP. Now, RRSPs are something that everyone is probably familiar with, and they give you the ability to, one, defer taxes from today by reducing your taxable income until the future when you pull money out of your RRSPs. Because when you hit 71, you're forced into a RIF, and you must start taking income out of your RSPs and paying tax on it. In addition, if you take the money out of your RSPs any earlier, you will be taxed in the year in which you withdraw the RSPs. Now, CPP is a little bit different. CPP is a pension, so it's not a tax. So when I mentioned earlier about the taxes being the same, I'm not including CPP. Now, Canada Pension Plan is got a low rate of return, but it does give you a guaranteed pension in retirement, which obviously as independent contractors, you're really not going to have any other form of pension. So what this does is provides a sort of minimum standard of living, and it is something that we do recommend and encourage that you contribute to CPP. Now, some people believe that with the aging demographic and fiscal mismanagement, that there may not be any pension left by the time they get to reach their retirement age. And obviously, I can't speak to that. My personal belief is that it will be there, but if you don't value CPP, then you can, of course, go with a dividend strategy, in which case you won't have to remit the employer or the employee portion of CPP. Now, one of the other things that we wanted to talk about today is personal service businesses. And I'm just going to check in to see if we have any questions real quick before I go into this. So it looks like we're okay. So personal service business, which some of you may have heard of and some of you may not, is defined as a personal service business carried on by a corporation in a taxation year, means a business of providing services where an individual who performs services on behalf of the corporation in this definition of paragraph 18.1p referred to as an incorporated employee, or B, any person related to an incorporated employee is a specified shareholder of the corporation, and the incorporated employee would reasonably be regarded as an officer or employee of the person or partnership to whom or to which the services were provided, but for the existence of the corporation. Now, that's a long-winded sentence to basically say the risk is that you're deemed to be an employee of the end client that you're consulting in. There have been a number of cases on this. It is not a new phenomenon. It has been going on for quite a bit of time. The first sort of landmark precedent-setting case was a case called the Weeby Door case. Prior to this, there were sort of few independent contractors. Everyone was mostly employees, particularly in the IT industry. It was mostly in-house, MIS-based services. Obviously, after the landmark case, they set out some key qualifying determinants, and they were the risk of profit or loss, ownership of tools, degree of supervision, and whether you were an integral part of the process. And as these rules came out, we started to see more and more people working as independent contractors. We started to see a lot of wins on behalf of the independent contractors. And as a result, for a long time, personal service business or personal service corporation risk all but disappeared. I'm going to step back for a minute. But there was a special case that happened fairly recently to bring PSB back into the fold. And that was a special project by CRA where they assessed 234 small businesses, and 96 of those small businesses were deemed to be PSBs or PSCs, of which about half were in the IT industry. The problem with this is that they disallowed the small business deduction, denied a lot of expenses, applied interest and penalties for the past 3 years, and gave these guys a fairly whopping bill. Now, we are currently in the process of fighting many of these cases, and the latest news is that there was a sort of big case that the NACCB, which is the National Association of Computer Consulting Businesses, was helping to support, and that case was settled. Unfortunately, it was hoped that that would be used as a precedent-setting case, but unfortunately the way CRA works is if they think they're going to lose, they don't fight the battle. And what that means is it's hard for us to get the precedents and the wins that we want to have. And to top it off, there was another case, a case called the Gomez case, with a guy who actually had been a contractor for CRA. who represented himself. And this is another example of why you never want to represent yourself. But he represented himself and lost. So while we won the case, we were behind, and there's a number of cases that were held in abeyance of this case are currently being settled mostly in favor of the independent contractors. There's still other people out there doing tremendous damage to the industry by representing themselves and losing and or settling when they don't need to be. Um, so the analogy I use about personal service corporation is it's a really high impact and it can be devastating, much like a shark attack. But also like a shark attack, the percentage of the population that is truly affected by this is actually quite small. So if you think of even the entire group that they target, which is only 234 people, as a percentage of even just the IP industry, let alone all independent contractors as a whole, the risk is actually really quite low. And you truly have a greater risk of actually being bitten by a shark than you do of being assessed PSB. So that being said, you do want to do everything that you can to mitigate that risk to ensure that you aren't deemed a PSB. So when we look at this, what we want to do is act like a business to be treated like a business. So we look at the control test, and we want to make sure control test and make sure that your contract is basically telling you what to do, not how to do it. The analogy I've used before is a painter. So if you had a painter coming to paint your bedroom, you would tell him what color you wanted the room to be painted, but you wouldn't tell him what wall to paint or what hours to paint. But of course, if he came to paint your room at midnight, you'd fire him. So you want to eliminate a lot of control that is often exerted by end clients in contracts and replace that with early termination clauses, which is actually in the best interest of everybody. The ownership of tools test, this has really been all but eliminated because they have deemed, for most cases, that the tools are really your knowledge base rather than the computer. Obviously, with security, these days they would never allow you to bring your own devices in. So it's not reasonable to expect that by using someone's computer, that those are the tools necessary to do the job. The tools necessary to do the job are the knowledge that you bring forth. Chance of profit or loss. Now I know specifically with the Procom contracts that there is risk written right into the contract when it comes to as far as your risk of getting paid if you don't get your time reports in. There's also risk, speaking with Andrea, about whether or not you'll be on your next contract. So as far as chance for profit or loss, I'd say you definitely meet that. Now, when it comes to the integration test and whether you're an integral part of the business, this is really where it comes down to having someone who can argue the merits of your case really well to ensure that you're not deemed to be a BSB, because a lot of this can be really subjective. Of course, a detailed written contract is just the opposite. It's not subjective at all. It's sort of the one item that's kind of black and white. And again, working with Procom, the advantage that you get is that I know for a fact their contract is pretty rock solid. Now, again, coming back to the subjective, it's your contractor conduct, and that's where things are really culminating these days. And the special project that they initiated was a survey, which was a series of questions where they asked contractors primarily around their contact, like, do you abide by the policies and procedures at your workplace? Do you have to be in there at a certain set of hours? And it's really easy to answer those questions in a way that can get you into a lot of hot trouble, or a lot of hot water. So it's really important to make sure that you have a professional help you to answer those questions, and don't try to answer them yourself, because you might think that you've answered them reasonably, but you've actually put yourself at risk, because obviously most people would say yes to, do you follow the policies and procedures at your workplace? And you have to be clear in how you answer that, because as an independent contractor, you are subject to a different set of policies and procedures than an employee who sits next to you. But of course, if you're not doing your job, there's an early termination clause. So you would act professionally and conduct yourself in a professional manner, not because you're obligated because of policies and procedures, but because if you didn't, you'd be terminated. And again, that's the same thing about hours. Do you have to be there in a certain set of hours? No. But if you weren't working the core set of hours that the employees are working, you couldn't be efficient and you couldn't do your job effectively. So you want to make sure that you are arguing the merits of your case in a way that's in line with the writing of the PSB law, and of course the different court cases that have been fought and won in the past on these different criteria. So what do we do to protect our clients about PSB? We have, as I mentioned before, our audit representation protection. It was originally brought forward to specifically address PSB, PSC, because when we were starting this in the early 80s and the Weeby Door case was fresh in everyone's mind, people weren't really sure whether they could do this or they couldn't do that. So what we said is we're going to stand up and stand behind our clients and help them with all these issues. And we've, in fact, never lost a PSB challenge since 1984, the entire time that we've been in business. How we do that is we have a proprietary 76-page response on the CRA PSB attacks that outlines every single court case that has ever been fought and won in the independent contractor's favor, and outlines how that relates to our client's individual situation. And 9 times out of 10, we'd slap that on an auditor's desk and then run for the hills just because they didn't want to read it. For the few who actually had the interest in reading it, usually in a couple discussions with us, that was usually resolved and without any implications on our clients. One of the other things that we have is we've also developed a sample response to the CRA questionnaire. So that questionnaire, if you do ever receive it, I'm happy to provide you a sample response. Of course, it is a sample response, and we do encourage everyone not to respond without seeking professional advice. I don't really care whether you use me or you use another professional, but I don't want anyone responding to anything from the CRA without professional guidance, because it's really easy to get yourself into more trouble than you think. And the reality is most problems are caused by independent contractors putting their foot in their mouth, not by what's actually written in their contracts or the way they really have been behaving. So that's my long-winded speech. I've gone just about an hour now, and I'm going to open it up for some questions. Next steps I would encourage everyone to do is book a free consultation with us. There's no obligation, no risk. Whether you're a sole proprietor or going to be incorporated, you do want to capture every single piece of data, because what I do find often is that people don't track the small items like stationery pens, pencils, even cleaning supplies, and those can add up to a lot of money. So put everything on a debit or credit card. Cash is a 4-letter word. It's the worst thing you can say to an accountant. So track everything on a debit and credit card. Use a web-based tool to track everything. And if you're not sure whether it's deductible or not, put it in the general expense category and let us or a professional review that with you. We'll determine the reasonableness of all the expenses, including the general expenses, through using our benchmarking, our business bulletins, and of course previous tax cases. So one of the other things, as I mentioned earlier, is we do have an exclusive offer for you guys today. Anyone who comes to us through Procom is eligible for this special offer. We will do the incorporation for $495, which is basically just the government filing fee, your name search, your corporate minute book and seal. If you try to get those all by yourself online, it will come to the same price as this. But we'll also do the minutes, sort of the organizational minutes, the shareholder minutes, the subscription of shares, the officers and directors registers, and the share certificates as well. So some extra time, which you might be able to do yourself, but of course that's all done by us. And most importantly, the share structure ensures that it's set up correctly from day one, because if you do ever have to go back and file an article of amendment, that article of amendment can be just as costly to set up. Now, I know some of you are probably looking at this and going, well, that might be the cost for an Ontario incorporation, but I can do a federal incorporation cheaper. So first of all, if you're doing a professional corporation, you can't actually do a federal incorporation. Secondly, if you do a federal incorporation, there is actually an obligation to register in each province, and there is a cost to registering in each province every year. So after about 5 years, the cost of a federal incorporation actually exceeds the total cost of a provincial incorporation. And the reality is there's no greater advantage and no disadvantage to using a provincial incorporation. But of course, if you're going to be in this for more than 5 years, you're actually going to be further ahead by going with a provincial incorporation. Um, that being said, that's everything I have to say for tonight. I'm going to open it up, try to unmute everybody, and see if anyone has any questions. So just bear with me a second while I do that, because there's a couple of us on tonight. And of course, you can type questions in. I'm also going to post a poll up here while I do that, actually, because I am curious whether you guys found this to be useful or not. I'm hoping it was. Okay. They're telling me if I unmute more than 5 people, it can result in poor audio. So apparently what we should do, and I apologize, I'm fairly new to the webinar for this many people. I'm going to mute everyone again. But if you do have a question, if you can raise your hand, or if you can actually post a question, that would be greatly appreciated. Let's see what everyone thought of the seminar. So I appreciate it if you wouldn't mind taking a minute to tell me what you thought, whether you liked it or not. That would be, you know, 20% of the votes in, so much, so far, so good. 29, 36, we're getting there. 43, 57. Feel free to be honest. Most people are saying very much, somewhat. If you have any problems or concerns, I've got a thick skin. We got about 64% in, 71, almost there, 79. Those last stragglers, give them a minute. %. I'll go with 92% and close the poll. Share my results. So looks like everyone was happy. So I'm glad I could add some value to you guys today. I know it's sort of hard for me sometimes when I don't hear, like I can't have that dialogue back and forth, so I sort of feel like I'm talking to a wall. It's definitely nice to have audio feedback, which is different. But like I said, if you do have any questions, please post them in the questions forum, which I actually, can we get a copy of? Someone asked if we can get a copy. Yes, I'm going to make a copy of the presentation available. So I made a recording. The slide deck is actually already available. You can ask Andrea or Sean for a copy, but I will make both slide deck and, assuming the recording goes well, I will make that available for you guys as well. There's also some handouts that I gave at the first presentation that address some of the FAQs that were provided to me the day or two before the first presentation. So that's available in a PDF format. For anyone who did get the physical copy, I apologize. Apparently I sent the unedited version to my printer. Didn't realize that until afterwards. But the edited version, the corrected version, is actually up on the site, available for download. Anyone have any other questions for me? Okay. So thank you everybody for joining me today. I'll let you log off and get out for that beer and pizza with each other, or whatever the case might be. If anyone has any further questions for me, feel free to reach out. You can connect with me by email, as I said earlier, at a.wall@ca4it.com, on Twitter at ca4it, or on LinkedIn. You can look me up under Andrew Wall. We're also on Facebook at Facebook/ca4it, all the usual social media channels. And I do encourage you and hope that people will reach out and connect with me on social media. I love to get feedback, in hopes of making this better for any future sessions we'll do. So thanks again, everybody, and I guess I'll close out. Bye for now.